Let's get to Bob Pisani and get a market check on this Monday. Morning, Bob.
Good morning, Carl. Happy Monday, everybody. Let's call it the hope for the lockdown easing rally, because that's what this is. Whether you're talking about the NBA, maybe reopening practice facilities, maybe Tesla recalling some people to its California facility. A lot of hope out there that things are going to start unlocking at this point. You see that in the sectors that are moving here. Semiconductors up today, and all the stuff that normally would move here. Banks, consumer discretionary, healthcare outperforming. There's your underperformer, energy, and there's a couple of very good reasons why energy is notably underperforming. The front month, June and July contracts are notably weak right now. If you take a look at some of the big energy names here, Diamond Offshore, that bankruptcy filing here, Hess and Occidental, their two biggest customers, they're probably 50% of the revenues for Diamond Offshore. So that's a company in trouble here. Noble, Rig, some of these other offshore drillers are essentially penny stocks at this point. They're down as well. Another issue, of course, is USO out there. That's the oil ETF, which has again changed the contracts that it's owned. It now owns 6 front-month contracts, not the June, but July and forward, all the way into 2021. They now own a 2021 contract. They're going to be buying those over the next few days. So there's obviously some selling pressure on the front-month contract. This has changed almost on a daily basis, the USO, the components of what they actually own. In terms of where we are right now, I said last week that we had sold out a little bit. Maybe more realistically, it's better to call it a bit of a consolidation right now rather than a retest. It's certainly not a retest, that's for darn sure. The S&P 500 going into the open was only 1% off its highs in April. Global stocks a little less than 2% off of their highs, and we're closing that gap with today's open pretty quickly. I think the key this week is earnings. We've already got 25% of the companies that have reported. There's been a stunningly wide dispersions in the estimates, just all over the place. And for the first time in 20 years, I don't put much stock in store in first half earnings estimates at all, because the visibility is just so poor. JPMorgan noted this morning that in their estimate, 90% almost of those reporting have withdrawn full-year guidance. A few are providing second quarter guidance. But when you can't figure out what's going to happen more than a month or two away, you've got a lot of problems there. And I think the markets are reflecting some of that uncertainty. In terms of the dispersion of the earnings right now, the estimates right now for the quarters, 15% for the first quarter. And the bottom, the market believes now, is the second quarter. Whether that actually happens or not is not clear. We've got 18% decline for the full year. These are bottoms-up estimates. Most of the top-down analysts are much worse than this. They're 20 to 33%. I think Goldman has 33% decline for full-year estimates. So these estimates are constantly revised almost on a daily basis, and they've just been coming down very, very rapidly. The two big risks are very obvious right now. It's a secondary wave of infections once this is lifted on a phased basis. And growth essentially restarts at a much slower pace because the social distancing requirement still constrains any kind of activity that's out there. So there's your two main risks. But as for today, the market's still believing the reopening story trumps the retest risk.